Mastering Wealth, Investment Strategies and Financial Trends for Long-Term Success. In the dynamic world of investing, numerous strategies and financial trends can significantly shape an individual's wealth-building journey. From the high-stakes environment of hedge funds to the quiet power of compound interest, the tools and methods available for building financial security and wealth are diverse and ever-evolving. In this article, we'll explore 4 critical investment concepts: hedge funds, passive income, compound interest, and the stock market. Each offers unique opportunities and risks with their own impact on both individual finances and the broader economy. Inside the world of hedge funds. Hedge funds are often considered the pinnacle of sophisticated investment vehicles, catering primarily to high-net-worth individuals, institutions, and accredited investors. These investment funds pool capital to engage in a variety of strategies, including equity investments, arbitrage, derivatives trading, and more. The aim is to generate high returns, usually with a focus on reducing or hedging risks. Here's a closer look at how hedge funds operate, their influence on the market, and their broader economic impact. What are hedge funds? A hedge fund is a pooled investment fund that uses advanced investment strategies to generate returns for its investors. Unlike mutual funds, which are typically bound by stricter regulatory guidelines and must adhere to a more conservative risk profile, hedge funds have more flexibility. They are typically structured as private investment partnerships, where the fund manager and a group of investors collaborate to pool their money. The fund manager is often an experienced investor who deploys strategies such as short selling, leverage, derivatives, and market timing to maximize profits. Hedge funds often aim to hedge against market volatility. Thus, their strategies are designed to perform well, regardless of whether the market is trending upward or downward. For instance, a hedge fund might take a long position in a stock expected to rise and simultaneously take a short position in a stock likely to fall, balancing out any risks. How hedge funds operate. Hedge funds typically operate with 2 main components: management fees. The fund manager charges an annual fee, typically 1–2% of assets under management, or AUM, for overseeing the investment strategy. This fee compensates the manager for their expertise and operational costs. Performance fees. In addition to the management fee, hedge fund managers generally take a performance fee of around 20% of the fund's profits. This aligns the interests of the manager with those of the investors, as the manager only earns a significant reward if the fund performs well. These funds can invest in a range of assets, including stocks, bonds, commodities, foreign exchange, and even private companies. The flexibility and wide range of tools available to hedge funds provide opportunities for high returns, but they also come with considerable risk. Hedge funds' influence on the market and the economy. Hedge funds are powerful players in financial markets. Their ability to influence stock prices and market trends is substantial, particularly because they are often early movers in identifying inefficiencies or opportunities in the market. Hedge funds can move markets, especially when they deploy large sums of money or take concentrated positions in certain stocks. For example, during the GameStop short squeeze in 2021, hedge funds like Melvin Capital suffered heavy losses due to retail investors on platforms like Reddit driving up stock prices, while the hedge funds had short positions expecting the price to decline. This incident highlighted the tension between hedge funds' high-risk strategies and more traditional investment approaches. The influence of hedge funds on the broader economy is also significant. By allocating capital efficiently and often focusing on underperforming sectors or companies, hedge funds can help redirect resources to more productive uses. However, their speculative nature and penchant for using leverage can also contribute to increased volatility, which can ripple through markets and impact the economy at large. Passive income, the wealth-building strategy of the rich. Passive income is a term widely associated with wealth-building strategies of the rich and financially savvy. Unlike active income, where one must work to earn a paycheck, passive income is earned with little day-to-day effort once the investment has been made. It's considered a key strategy for those who wish to generate wealth over time without being actively involved in every aspect of their finances. What is passive income? Passive income refers to earnings derived from investments or businesses that require minimal daily management. The most common sources of passive income include dividends from stocks. Investors can purchase shares of dividend-paying companies, which provide regular payouts to shareholders. These dividends can then be reinvested to increase the number of shares owned, accelerating wealth growth. Real estate income. Real estate investors can generate passive income by purchasing properties and renting them out. Rental income can provide a steady cash flow, and property values may appreciate over time. Royalties from intellectual property. Creators such as writers, musicians, and inventors can earn royalties from their intellectual property, whether it's book sales, music streaming, or patent licensing. Side businesses. Many entrepreneurs create businesses that require minimal ongoing involvement, such as automated online stores, affiliate marketing, or franchise operations. Building wealth with passive income. The key to building significant wealth through passive income lies in choosing investments or assets that generate consistent returns over time. For instance, real estate often involves an initial outlay for the purchase of a property, but generates rental income that can last for years. Similarly, dividend-paying stocks may require a large capital investment up front, but the returns become increasingly significant as dividends are reinvested and compound. The advantage of passive income is that it allows wealth to accumulate without the necessity of active labor. Over time, these sources of income can outpace the amount of money one would earn through traditional employment, enabling investors to achieve financial independence. High-income earners often use passive income as a strategy to diversify their wealth portfolio and reduce dependence on earned income. The power of compound interest. Often referred to as the eighth wonder of the world, compound interest is one of the most powerful forces in finance. The concept is deceptively simple. Interest is calculated not just on the initial principal, but also on the accumulated interest from previous periods. This exponential growth can lead to significant wealth accumulation over time. Why it's called the eighth wonder of the world. Albert Einstein is often credited with calling compound interest the eighth wonder of the world because of its remarkable ability to exponentially grow wealth over time. The key to maximizing compound interest is time. The longer the time horizon, the greater the potential for wealth accumulation. This is why early investing starting in one's 20s can lead to far greater financial success than waiting until later in life. The power of starting early. The earlier you begin investing, the greater the impact of compound interest on your portfolio. Even small investments made early can grow substantially over time, given enough time to compound. This is why retirement accounts like 401ks and IRAs, which benefit from compound interest, are central to long-term wealth-building strategies. The stock market investment. When it comes to long-term investing, two of the most common asset classes people turn to are the stock market, but they come with their own unique sets of risks, rewards, and financial goals. Stock market investment. Investing in the stock market provides exposure to a diverse range of companies, industries, and markets, allowing investors to capture growth across the global economy. Stocks are bought and sold on public exchanges, and their value can fluctuate greatly based on a company's performance, market sentiment, and economic conditions. Pros of stock market investment. Liquidity. Stocks can be bought and sold quickly, providing flexibility and access to funds. Diversification. Investors can spread their risk by purchasing stocks in multiple sectors and regions. High potential returns. Historically, stocks have offered higher average annual returns compared to other investments. Cons of stock market investment. Volatility. Stock prices can fluctuate widely in the short term, especially during market crashes or economic downturns. Market timing. Successful stock market investing often requires timing the market, which can be challenging. By understanding how these financial strategies work and assessing their unique risks and rewards, Individuals can make informed decisions that align with their financial goals and help them navigate the complexities of the financial world.